When people imagine the IRS reviewing tax returns, they usually picture something very specific. They picture a person sitting at a desk, looking directly at their return, deciding whether it looks suspicious. And that image alone is enough to make people nervous. But that's not how this works. Not even close. Long before you ever receive a letter, long before anyone could possibly contact you, your return has already moved through multiple layers of screening. Most of those layers are automated. Most of them are procedural, and most of them never involve a human being at all. In fact, the overwhelming majority of tax returns are processed, accepted, and closed without anyone ever taking a second look. Today's episode is about what actually happens in that space before a letter exists. We're going to talk about how the IRS screens returns, what diff scoring really is without the mystique, why some returns get looked at and most don't, and what actually triggers extra attention without fear-mongering or scare tactics. This is not an episode about how to avoid the IRS. It's not about loopholes, and it's definitely not about hiding anything. It's about understanding the system. Because when you don't understand how returns are reviewed, fear fills in the gaps, and fear turns routine procedures into imagined disasters. By the end of this episode, you'll understand that a return review is not an accusation, a letter is not the beginning of the end, and attention does not mean wrongdoing. You'll also understand something most people never hear explained clearly. Congress, not the IRS, decides the scope of enforcement, and that matters far more than individual behavior in isolation. So if you've ever wondered, why did their return get looked at and mine didn't? Or what happens before a letter is sent? This episode is for you. Let's start at the very beginning. What happens the moment a tax return is filed, and what doesn't happen right away? The moment you file a tax return, whether electronically or on paper, something very important happens. Your return enters a processing system, not an evaluation process. And that distinction matters more than anything else we're going to talk about today. Because the first phase your return goes through has nothing to do with judgment, suspicion, or scrutiny, it's about intake. Think of it less like an investigation and more like mail sorting. Once your return is submitted, the IRS's first job is simply to receive it and capture the data. At this stage, the system confirms the return was received, the information is digitized and standardized, and basic identifiers are checked. No one is evaluating whether your deductions look right, no one is deciding whether your income seems high, no one is comparing you to anyone else yet. This phase exists to answer one question only. Do we have a return on file for this taxpayer? That's it. After receipt, the return goes through a basic validation check. This includes things like math verification, required fields being present, filing status consistency, obvious calculation errors. These checks are mechanical. If something doesn't add up, the system doesn't assume wrongdoing, it flags the return for correction or clarification, often without any human involvement at all. This is where many people first hear from the IRS, but not because they're being reviewed. It's because a number didn't calculate properly, a form was missing, or information provided didn't flow properly. These are processing issues, not compliance issues. At the same time your return is being processed, the IRS is also receiving information from third parties. This includes employers sending W-2s, banks sending interest statements, platforms issuing 1099s, and brokers reporting investment activity. These documents don't immediately trigger action. They are logged, stored, and matched over time. An important point here, matching is not instantaneous. Your return is not being checked against every third-party document the second you file. Those streams of information arrive on different timelines, and the system accounts for that. Which is why some issues surface months later, some notices arrive long after filing, and some discrepancies resolve automatically. None of this means someone is watching your return, it means the system is doing what systems do, aligning data. And this is where confusion sets in for a lot of people. Processing does not mean your return is being reviewed for accuracy in the way most people imagine. Processing means your return exists. It can be read, it can be stored, it can move forward. Review, actual review, comes later, and only for a small subset of returns. Most returns never move beyond processing. They're filed, they're accepted, they're done. At this stage, the IRS is not evaluating your lifestyle, judging your deductions, assessing intent, or comparing your behavior to others. There is no agent reading your return line by line. There is no decision being made about whether you deserve attention. That comes much later, and only for some returns. Understanding this phase alone removes a huge amount of unnecessary fear. Because when people hear the IRS has my return, they imagine scrutiny. But what's actually happening is logistics, and logistics don't carry emotion. Here's the grounding truth I want you to remember. Filing a return does not put you under a microscope. It puts you into a system designed to handle millions of filings efficiently. Most returns move through quietly, most returns end quietly. Most taxpayers never hear anything at all. In the next section, we're going to talk about what happens after processing, how returns are screened, what automated filters actually do, and why screening is about sorting, not suspicion. That's where things like consistency and pattern recognition come in, and once you understand that, the process makes a lot more sense. Let's talk about how returns are screened next. Once the return makes it through processing, this is where most people's imaginations start to run wild. They think screening means judgment. They think it means suspicion. They think it means someone is deciding whether they've done something wrong. But IRS screening isn't about morality or intent. It's about sorting. The IRS processes tens of millions returns every year. There is no universe in which humans can manually review even a meaningful percentage of them. So instead, the IRS uses automated systems to answer one basic question. Which returns, if any, are worth spending limited human resources on? Screening exists because time is limited, staff is limited, budgets are limited. It's a prioritization tool, not a policing tool. At a high level, screening systems look for internal inconsistencies, mismatches with third-party information, patterns that deviate significantly from statistical norms. That's it. There's no personality analysis, there's no behavioral profiling, there's no judgment call about whether something feels off. It's data compared to data. One of the biggest factors of screening is consistency. The system looks at your return compared to your prior returns, your return compared to others with similar profiles, and whether numbers tell a coherent story together. For example, income increases paired with reasonable expense changes, deductions that align with reported activity, credits that match eligibility rules. Consistency doesn't mean sameness year after year. It means explainability. Life changes, businesses grow, income fluctuates. Those things aren't suspicious, they're normal. What draws attention is when changes happen with no clear connection to reported facts. Information return matching. This is where a lot of anxiety comes from, so let's talk about it plainly. When employers, banks, platforms, and brokers send information to the IRS, those forms don't automatically trigger action. They are logged, stored, and matched over time. Matching is not instantaneous, it's not aggressive, and it's not punitive. If something doesn't match, the system notices it. It doesn't immediately accuse, it often waits for additional data or corrections. That's why some notices come months later, not because something was found, but because information arrived later. And this part matters. Screening systems are not designed to catch small mistakes, penalize honest errors, target specific types of taxpayers, or enforce perfection. They are not looking for one questionable receipt, a slightly miscategorized expense, a round number that looks weird, a single missed form that can be corrected. They are designed to identify returns with the highest potential impact because resources are finite. Up to this point, no one has decided whether your return is good or bad, whether you're compliant or non-compliant, whether you deserve scrutiny. All that has happened is sorting. Most returns never move beyond this phase. They're screened, they're deemed low priority, and they're done. People fear screening because it's invisible. You don't see it, you don't get notified, you don't get feedback. And when something happens quietly, the mind fills in the gaps. But screening isn't judgment, it's logistics. Here's the grounding truth from this stage. Screening is about identifying outliers, not accusing taxpayers. Most returns fall well within normal ranges. Most returns are never flagged. Most returns move through without incident. Next, we're going to talk about the concept that gets mentioned most often and misunderstood the most when people talk about the IRS review: diff scoring. What it actually is, what it actually does, and why hearing the word diff shouldn't raise your blood pressure at all. Let's talk about that next. If there is one acronym that causes more unnecessary panic than almost anything else in tax season, it's this one: DIF, D-I-F. You'll hear it referenced online as if it's a secret score, like a credit score, like a moral ranking. It's none of those things. So let's slow this down and talk about diff scoring in plain English. DIF stands for Discriminant Information Function. That sounds intimidating, but the concept behind it is actually very simple. DIF is a statistical comparison tool. That's it. It compares the information on your return to returns with similar characteristics, returns with similar income levels, returns with similar types of activity. And it asks one basic question. How similar is this return to others like it? That's not an accusation. It's a math problem. Think of DIF like this. If you lined up thousands of tax returns that look broadly similar, same income range, same filing status, similar business activity, most of them would cluster together. That cluster is normal. DIF helps identify outliers, returns that fall far outside that cluster. Outliers are not wrong, they're just different. And difference alone doesn't mean action. A high DIF does not mean an audit. This is the most important thing to understand. A high DIF score does not automatically lead to an audit, a letter, human review, or penalties. It simply means this return looks statistically different from its peers. Many high DIF returns are never touched. Many are reviewed briefly and closed. Many are explainable on their face. DIF is a sorting tool, not a verdict. And there's a flip side that people rarely talk about. A low DIF score does not mean you can't be reviewed, you can't receive a notice, or you're invisible. It just means your return aligns closely with statistical norms. Other factors still matter, such as information mismatches, missing forms, carryover issues, prior year adjustments. DIF is one input, not the whole system. Now let's be very clear about what DIF does not measure, because this is where fear creeps in. DIF does not measure intent, honesty, character, effort, or how careful you were. It does not know why numbers changed, what your business actually does, what happened in your life that year. It only sees data. Small business returns often generate more DIF discussion because they have more variables, they involve judgment calls, expenses can vary widely, and income may fluctuate significantly. That variability doesn't mean risk. It means complexity. And complexity is exactly what statistical tools are designed to sort, not punish. And here's the part that gets lost online. DIF does not act alone. It works alongside resource availability, enforcement priorities, congressional funding, broader compliance initiatives. A return can have a high DIF score and still never be touched, simply because resources are directed elsewhere. Here's how I want you to think about DIF going forward. DIF is not a spotlight, it's a sorting hat. Most returns are sorted out of review. A few are sorted in. And even then, review doesn't mean enforcement. Understanding DIF removes a huge amount of fear, because it turns something mysterious into something mechanical. So remember this, DIF is statistical, not personal. High DIF is not an accusation. Most DIF flagged returns never result in audits, and explanation matters more than the difference. Next, we're going to talk about why some returns actually get looked at, why most don't, and how that decision is made in practice, not theory. Because DIF is only one piece of a much larger picture. Let's talk about that next. At this point, it's important to zoom out, because once people hear about screening systems and DIF scoring, they often assume there's a straight line from flag to audit. There isn't. In reality, most returns are never looked at by a human being at all, even after screening, even after DIF scoring. So let's talk about why some returns move forward for review and why the vast majority quietly exit the system. The reality of volume versus resources. The IRS processes tens of millions of individual and business returns every year. Even in years with increased funding, the IRS does not have enough personnel, enough time, enough budget to review more than a very small percentage of those returns. So decisions about review are not just about risk, they're about resource allocation. That's a crucial concept. Review is about impact, not minor errors. Returns that move forward for human review usually share one thing in common: potential impact. That impact can be significant tax dollars involved, large discrepancies that can't be resolved automatically, issues that repeat across multiple years, and patterns that suggest ongoing non-compliance. Notice what's not on that list: small math errors, one-time mistakes, minor misclassifications, honest confusion. Those are typically handled through automated adjustments or correspondence, not examinations. Based on how the system actually works, returns are more likely to receive human attention when there is unreported income that doesn't match third-party information, large deviations from prior year filings with no clear explanation, Claims that statistically don't align with reported income carry forward issues from prior years that were never resolved and repeated inconsistencies over time. Even then, review does not automatically mean audit. Often it means a closer look, a short internal analysis, a decision that no further action is needed. Most reviewed returns are closed without taxpayer contact. And let's break this down by filing type, because these triggers often look different. For individual filers, reviews often center on income mismatches, credit eligibility, filing status inconsistencies, third-party reporting conflicts. And for small business owners, reviews are more likely to involve gross receipts versus expenses that don't align, losses that continue year after year, expenses that don't match the type of business, and significant changes without documentation. None of these automatically mean wrongdoing. They mean the system needs clarity. And this part is just as important. Returns are not automatically reviewed because you're self-employed, you claimed legitimate deductions, you owe tax, you received a refund, you made a mistake, you filed late, you extended. Those are normal aspects of tax compliance. And most returns are internally consistent, match third-party data, fall within expected ranges, and don't present high-dollar issues. So they move through the system quietly. No letter, no notice, no follow-up. And that's the experience most taxpayers have every year, even if they don't realize it. Here's the perspective shift that matters the most. The IRS is not trying to review as many returns as possible. They are trying to resolve as many returns as possible with the least friction. Review happens only when the system can't resolve something on its own. So remember this. Review is selective, not universal. Impact matters more than perfection. Most returns are resolved without human involvement, and silence usually means success. Next, we're going to talk about that phrase that gets thrown around the most, triggers, and what actually does and doesn't trigger extra attention, without turning it into a checklist or fear. And then we'll move into something most people never hear explained clearly, how Congress, not the IRS, shapes audit scope and enforcement priorities. Let's keep going. Let's talk about the word everyone fixates on, triggers. Online, triggers are often framed like landmines. Step on one and something terrible happens. That framing is wrong. In reality, triggers are not punishments. They're signals that the system needs clarification, and most of them are very straightforward. Trigger number 1, unreported income. This is the single most common reason returns receive extra attention. When income reported on a tax return doesn't match income reported by third parties, the system notices. This can happen when a 1099 is missed, income is reported net instead of gross, and a form arrives late or corrected. This doesn't imply intent, it implies a mismatch. And mismatches are usually resolved through correspondence, not audits. Trigger number 2, large unexplained changes year over year. The system expects life to change. It does not expect changes with no narrative support. Examples: income drops dramatically, but expenses increase. Credits appear or disappear without explanation, and a business shifts from profit to loss repeatedly. Changes aren't suspicious. Unexplained changes are incomplete stories. Trigger number 3, claims that don't align with reported income. This is where statistical tools come back into play. When deductions, credits, or expenses are claimed at levels that don't align with reported income, the system may want a closer look. Not to accuse, but to verify. Verification is normal, it's procedural, and it's usually resolved with documentation. Trigger number 4, repeated inconsistencies across multiple years. One-time issues are rarely escalated. Patterns are. If the same discrepancy appears year after year, especially after prior contact, the system may elevate review. That's not about punishment, that's about resolution. What this section is not. This is not a checklist to avoid, it's not a warning label, and it's not meant to create hypervigilance. It's simple clarity about how systems prioritize limited resources. Triggers are about questions, not conclusions. This is one of the most misunderstood parts of the entire tax system, and it's critical for perspective. The IRS does not decide how aggressive enforcement is. Congress does. Congress determines IRS funding levels, staffing capacity, enforcement priorities, and legislative focus areas. When you hear headlines about increased audits, decreased audits, focus on certain income levels, and shifts in enforcement, Those decisions originate with Congress, not frontline IRS employees. So, what does the IRS actually do? The IRS implements laws passed by Congress, operates within budget constraints, and allocates resources where directed. Agents don't set policy, they follow it. And when resources are limited, which they always are, enforcement becomes targeted, not widespread. So why does this matter to taxpayers? This explains why audit rates rise and fall over time. Certain issues receive attention in some years, but not others, and enforcement focus shifts at a macro level. It's not personal, it's political and procedural. Understanding this removes the idea that the IRS is arbitrarily cracking down. They're executing policy within constraints. So what's the key takeaway here? Enforcement trends are macro-level decisions. Individual taxpayers are not singled out in isolation. Your return exists inside a system shaped by law, funding, and policy, not emotion. And lastly, let's talk about letters, because this is where fear spikes the fastest. An IRS letter does not mean you're in trouble, you're being audited, or you did something wrong. It means the system needs communication. Most IRS letters are requests for clarifications, notifications of adjustments, information matching notices, or status updates. They are not accusations, they are not enforcement actions, and they are not judgments. They're part of how a large system communicates. Letters exist because not everything can be resolved automatically. The system needs documentation, and timing mismatches need explanation. Letters are often the least intrusive way to resolve an issue, and most letter issues are resolved without escalation. A letter means the system needs more information. That's all. And responding calmly and clearly is almost always the fastest path to resolution. Let's bring this home. Here's what you now understand that most people don't. Most returns are never reviewed. Most reviews never become audits. Most audits resolve without penalties, and most letters are procedural, not punitive. The IRS system is not watching you. It's sorting data. Fear thrives in mystery. Confidence comes from understanding. And that's what this episode and this season is about. If this episode helped reframe how you think about IRS review, I encourage you to subscribe to the podcast, share this episode with someone who fears getting flagged, and come back as we continue breaking down IRS processes without panic. In the next episode, we'll talk about IRS notices specifically, how to read them, what they actually say, and what they're asking for, so you never feel overwhelmed by a letter again. Thanks for listening, and we'll talk again soon.